Well, howdy, ladies and gentlemen. Welcome back to Economics Class Live from the Yard. Uh, Today we're going to start looking at savings and investment, and just some kind of key things that you want to know about those things. So, just some opening vocabulary things. So, first off, savings is a term we use for income that is not intended for consumption. That is, savings is money that you're trying to put away and not use for a particular period of time, and you can use that kind of informally to mean just kind of money that you have mentally earmarked, but you also formally to refer to money that you have in things like savings accounts or other things that you don't have immediate access to. And then secondarily, investment is the use of income today that allows for a potential future benefit. So when you invest money, you give up the use of it somewhat today, such as through buying stocks in a company or helping to fuel a business interest or a startup or something like that, with the idea that you're going to eventually reap a return when that company becomes profitable at some point in the future. So investment is when you take your money and you put it towards something that you're going to have a temporary loss in the short term, but in the long run, it's actually going to make you money, or at least that's the goal and that's the intention of it. And there's a couple different types of investment. So you've got your economic investment, which is money that's lent to businesses to finance something like building a new factory or something like that. And then you also have your personal investment, which is where people put their savings into financial assets. Um, Pardon. Uh, so so think about if you're, for a minute, when you put your money into a savings account, you're benefiting immediately in having a place to store your money. You're going to be able to have, a small amount of interest paid to you as you have lent the money to the bank in that way. But you also make funds available for others. That the bank is going to lend out. So, pardon me. So, if, for instance, no one put any of their savings in the bank, then when you went to go to the bank and to ask for help with a mortgage or something like that, there would be no money for them to lend out. So it's actually a little bit of a public service having stuff in your savings account, in a weird way. So, obviously people being able to borrow money from the banks and so on is able to help kind of fuel the growth of the overall economy. And so the financial system is a term that means the institutions that help to transfer funds between savers and investors. That is banks, credit unions, life insurance companies, mutual funds, pensions. All of those are part of the financial system. So a couple different terms you want to know. So a financial asset is a claim on the property of a borrower, and that is, the concept of collateral that we talked about the other day in the banking video. And normally some kind of financial asset is on the line when a loan is taken. So in the case of a mortgage, it's the house that's being bought, or if you were to put a lien on a car or something like that in order to get another loan or something like that. So there's a couple different ways that there's a couple different ways that savers and borrowers can be brought together. So one is a financial market, which is where they exchange assets directly. And an example of this is buying stock or buying corporate bonds, which we'll talk more about stocks and bonds in the next video. The short version is stock is partial ownership of the company. Buying a bond is where, if you buy, let's say you buy a $100 bond with a 10% return, then you buy the $100 bond, and then at a certain date you get paid 110 later on. However, a lot of times the savers and borrowers are brought together through financial intermediaries, and some of those intermediaries could be So that's any kind of financial institution that collects funds from savers and invests them in loans and other assets. And some of those intermediaries are banks, pensions, all those things that we talked about as parts of the financial system. So we've already talked about one group of financial intermediaries, the banking industry, in a previous lesson. But there's a few other types that you want to know. One is finance companies, which make small loans. There's pension funds, which are invest money for groups of workers. So a pension fund, a lot of times they're connected to a particular business or a labor union or something like that. And the pension fund is, if you get a job where one of the benefits is retirement, a lot of times where that retirement account actually comes from, it's actually a pension fund that is owned by either that is doing business either with the company or the union, depending on how it's set up, and it's basically a portfolio of stocks. So one of the reasons why people get really excited when the stock market goes up, or really anxious when it goes down, is because a lot of people's retirement is directly tied to the condition of the stock market, because it's in the form of a pension fund. And then life insurance companies invest funds that are collected from policyholders as well. So when you pay your life insurance or whatever, there's some of that money is invested, similar to what the bank does with money. And then, of course, this is an important one, and we'll talk about, this is going to come up a little bit more too, but a mutual fund is an investment company that gathers money from individual investors and purchases a range of financial assets. So if you want to buy stock, there's a couple of ways that you can go about it. One is by really kind of micromanaging, like I want to buy so many shares of Microsoft and so many shares of PepsiCo and so many shares of, whatever. But the reality is, if you are doing anything other than dedicating your whole life to studying investment, in which case you would probably be working on Wall Street. If you're trying to invest money on the side while continuing to run a real, ordinary job, it's going to be hard to really micromanage accounts that much. So mutual funds are where you go to them, and I think Merrill Lynch, might be an example, might be one. I think they're a mutual fund. I could be wrong, but like mutual funds, you go to the mutual fund and they invest money for you, and they typically invest in a range of different assets. And so, depending on what kind that you want, you can go and you can get either some mutual funds are really high risk, some of them are really safety first, most of them are in the middle. And the idea is, as my studio is about to be blown over by the wind here, holding it up. Okay, so the idea is that by having investments in a wide variety of things, you're a little bit more, your investment is safer than if all your eggs are in one basket. So let's say that you had, decided, hey, I'm going to put all of my money in oil companies, 10 years ago, back when the price of gasoline was, pushing $5 in most parts of the world, or most parts of the country. Well, you would be in kind of a rough spot today, as the price of oil literally went negative yesterday for the first time in history, meaning that they're literally paying people to take oil off their hands at some of these refineries and stuff like that. So, and gasoline is down, $1.60 in some places, right? So you'd be making a lot if you invested all your money in what looked like, and there was a time where it looked like the price of gas was going to keep going up and up and up. Well, now it's going down, down, down. If all of your money was in that one industry, you might be in a world of hurt if you'd invested tens of thousands of dollars into that, right? So you don't want to have all your eggs in one basket. So a mutual fund, the idea is that it enables you to have a diverse portfolio. Some of your money is going to go into energy. Some of it's going to go into medical. Some of it's going to go into technology. Some of it's going to go into services. Some of it is going into food industry. Some of it's going to go into consumer entertainment. Some of it's going to go into life insurance and financial corporations. So you can go on and on and on. So with that, one industry taking a real downturn isn't going to cripple your whole you know, your whole investment plan with a mutual fund. And so that's kind of how that works. So all right, so you've got a couple different types of intermediaries. You've got your banking financial intermediaries, which you've already talked about, includes commercial banks, S&Ls, and credit unions. They provide checking and savings accounts. Depositors can also earn interest on saving deposits and some checking deposits. All of them also offer what they call CDs, or certificate of deposit, and money market deposit accounts that pay higher rates of interest. And they are backed by the FDIC up to $100,000. So the first $100,000 that you have in your account is backed by the government in the event of a bank run. And then you have your non-bank financial intermediaries, which are things like mutual funds, pension plans, life insurance companies, etc. All right, so there's a couple different ways that the financial asset markets are divided. So you've got the capital market, which is where long-term financial assets are bought and sold. And then you've got the money market, which is where the short-term assets are sold. So your capital markets are markets where there are assets that are held for longer than a year. And so things on the capital market are stocks, bonds, mortgages, long-term CDs. And because those are loans for longer periods of time, the money may be invested in projects that require large amounts of capital, such as buying homes, building factories, etc. Money markets, on the other hand, are where loans are made for less than a year. Those can be short-term CDs. Those can be treasury bills, which allows the government to borrow money for short periods of time. And you also kind of break the capital market, or excuse me, break the financial asset market into, oh, the wind's a blustery right now. Hold on. Trying to keep the studio from falling over here. All right. So you also have primary and secondary markets. So primary markets are where the first issue of a stock is sold to the public through investment bankers. The secondary markets are resale markets for assets, and they offer liquidity to personal investors. Liquidity meaning the ability to actually turn the assets that you own into cash on hand if need be. It's possible. Weather in the storm, boys and girls. Or weather in the storm. All right. We have survived. We have survived. And class may continue. So, in addition, feel like the guy on the Weather Channel in the famous clip where he's like holding on for dear life and the people are just taking a stroll behind him, trying to make everyone think a storm is going. It's not a major storm, but the studio is pretty flimsy. So anyway, there's kind of two kinds of markets. The primary market is where, you know, stock and things like that are sold directly. Secondary markets are where you can turn your assets into cash pretty quickly. So stocks and bonds are two of the prominent assets on the secondary market. So let's say you want to go about investing your money. You know, what's kind of some of the basic principles of how you go about doing that? Well, I'm not going to pretend to be anybody's Wall Street expert, but thankfully I have a textbook. That's right. So I can tell you at least a little bit of these fundamental things. So some of this is common sense. So the first thing, if you're kind of trying to determine exactly how to go about investing, there's a couple. There's a couple things you want to keep in mind. One of the things is the question you have to ask yourself: what is it that you're actually trying to invest in? Are you trying to invest like to get savings for retirement, or are you like trying to save up some money to take a vacation, right? Because that's two very different plans, right? And it's going to depend, and what types of markets you're going to try to invest in, or you know, is going to be very different depending on what it is you're trying to save for. So if your primary goal is to, you know, stockpile a decent little nest egg to when you retire, then you're going to want to focus on long term. You're going to want to have things that can accrue interest for long periods of time. And you actually would be surprised if you start making, wise investments, even at an early age, even when you're in your college years and stuff, you can actually have a pretty decent chunk of change, by the time you retire, just from, interest accruing if you don't touch it. That's kind of one little regret I have, is I didn't really do a whole ton of that, earlier on. Um, but you actually can make pretty good money just from sitting on interest, in a lot of areas. Obviously, if you're trying to save money to do something in the short term, you need to, do investments that'll get you more liquid assets at a quicker rate. So the other issue besides time is your income level, because the question is, how much do you have left after you've dealt with your necessities that you can save or invest. And then what's your income going to look like in the future. One thing you want to keep in mind is you don't want to put a bunch of money into investment if you're in a ton of debt, because the reality is the interest payments that you're making on credit card debt are probably going to be more than the interest that you're going to get back, having your money invested in a lot of different ways. So, getting out of debt is, and not paying more and more interest is priority number one before you start trying to gain interest in other ways. If you're trying to have savings for emergencies, and you should have, it's a sad fact that I think I've seen statistics that something like, I think it was more than half of Americans. I think it was maybe 65% of Americans don't have savings on hand for a $400 emergency. Well, that's a problem, because $400 emergencies can happen very easily, whether it's a medical thing, whether it's a car accident, a lot of things can happen that are going to be that kind of price tag, and you don't always have a choice. I had to deal with a situation last year where my hot water heater went out, and I couldn't just suck it up, because I get a decent amount of my money from subletting rooms. So so you had to get your hot water fast, because you didn't want tenants to leave, and then I'm really up the creek, right? So I had to go ahead and buy a hot water heater really fast. Unfortunately, that required me having to do things like credit cards, because I didn't have enough money saved up. Thankfully, I'm in a little bit better situation now if something like that were to happen again. So, but emergencies pop up. So you need to have some of your savings. If your savings for like short-term emergencies, you need to be able to get to it quick, because the definition of emergency is it's emergency. It's coming soon. So in that case, you want it to be in things that keep your money liquid, like savings accounts, money market accounts, and the risk of loss is very low in those, and you can get the money out anytime. But if you're saving for retirement, you play it different. That's a whole different, and you probably should have long and short-term investments if you have the ability to do that. If you're saving for retirement, you don't want to worry about liquidity. You don't want to worry about being able to pull it out of the bank really quick. You want to worry about what's going to give you the most return down the line, and not thinking and not ruin your financial future by thinking overly concerned with the short term. So you would want to do things like, whether it's long-term CDs, whether it's investment in certain stocks, things like that are going to pay off down the line at a higher interest level. One of the main things you always want to consider when you're investing is that there is an inverse relationship between risk and reward. Meaning, if the reward is the payoff, from the investment, and the risk is the possibility that you lose what you put into it, the reality is that the thing that is the safest in terms of guaranteeing you're not going to lose the principal are really basic things like savings accounts. But you're never going to get rich off of savings accounts. If you want to get rich, you got to kind of take a swing at some stuff on the market. If you went back into the 1990s, there were, and into the very beginning of the 2000s, when the internet was first really taking off and becoming a part of the culture, hundreds of little startup internet companies went broke, and a lot of people had invested a lot of money thinking that I can ride this internet thing to riches. Well, a handful of them did, and they've got names like Jeff Bezos and Mark Zuckerberg, and they're some of the wealthiest people in the world. But yet there's a lot of people that bet on the wrong horse and came up broke and lost tens of thousands of dollars, and some people may have even lost millions, investing in these new young tech stocks, thinking that's the way of the future. And they were sort of right, but it's a risk-reward thing. For every one Amazon, there were 10 companies that wanted to be Amazon that went broke before they could get rolling. So there's a certain risk-reward ratio that you sometimes, hey, Babe Ruth was, the greatest home run hitter of his era. He also is the all-time leader of strikeouts because he swung for the fences every time. There was no trying to get a base hit for Babe Ruth, right? It was swing for the fence or you're out. And so sometimes the people that become the richest are the ones that are willing to be poor if need be. A lot of people are kind of comfortable. They don't want to risk being kind of comfortable in order to become exorbitantly more comfortable. And that's just really a matter of your personality. What do you like better? Would you rather just know that you can be content and you're okay and you've got enough money to get the kids through college and you'll be all right? Or do you want to say, I have a possibility that I could be socially demoted by the way this business fails, but I also have a chance that I could be sitting around eating caviar? That's going to be really dependent on your personal risk aversion. I mean, it's basically your personality trait and so on. Typically, though, especially if you're going through mutual funds and stuff like that, you kind of want to have a portfolio that's kind of balanced with a combination of kind of high yield, high risk stocks and low yield, low risk stocks. That's one of the good things about having a mutual fund or something like that is they're investing in a number of companies at a time. Some of them are safe bets that'll get you base hits, and then some of them are going to swing for the fences. And when the swing for the fences companies have struck out, those base hit companies will still kind of have you making a little bit of money and offsetting some of those losses. And then, when those swing for the fences companies hit it out of the park, you also have some base hits coming up behind too. After the grand slam, there's still a man on base in this case, which is not technically possible in baseball, but it's an analogy. So, so it's just good to kind of have a mixture of the two in your investments. And so that is a concept that they call diversification. So, diversification, I use that in terms of stocks, but it's also like having some of your assets in stocks and some in bonds and some in CDs and some in money market accounts and some in savings accounts. That's a part of diversification as well. Where do you spread around the assets that you have for saving and investment? So, anyway, have yourselves a good day, and I will see you shortly.